Everyone wants passive income. And in the world of crypto, the promise of earning money while you sleep has attracted millions of people, many of whom lost everything chasing yields that were too good to be true. The collapses of Luna, Celsius, and FTX wiped out billions of dollars and destroyed the credibility of an entire category of crypto income strategies. But not everything collapsed. Some strategies survived, matured, and are generating real consistent returns for people who understand what they are doing. This is what is actually working in 2026. Chapter 1: What changed? After the collapses, before diving into what works, it is important to understand what the crypto landscape looks like after the disasters of 2022 and 2023. The era of 20% annual yields on stablecoin deposits is over. Those returns were not generated by real economic activity. They were funded by token inflation, unsustainable incentive programs, and in some cases outright fraud. When the money stopped flowing, and the yields collapsed and the platforms failed. Millions of people learned the hard way that if a yield sounds impossible in traditional finance, it probably is impossible in crypto too. What survived and what is growing in 2026 is different. It is grounded in real economic activity, actual fees generated by actual usage, actual security provided by actual validators, actual liquidity needed by actual traders. The returns are lower than the insane numbers of 2021, but they are real, and they are sustainable. The other major shift is regulatory clarity. Several major jurisdictions have now established clear frameworks for crypto income. This has brought institutional money into legitimate yield strategies and created more stable infrastructure for individual participants. The Wild West era is not completely over, but the landscape is significantly more mature than it was 3 years ago. Chapter 2: Staking is the most straightforward and widely accessible form of crypto passive income, and it remains one of the most reliable in 2026. When you stake cryptocurrency on a proof-of-stake network, you are essentially locking up your tokens to help validate transactions and secure the network. In return, you earn a percentage of the transaction fees and newly issued tokens generated by the network. It is conceptually similar to earning interest on a bank deposit, except the yield comes from network activity rather than lending. Ethereum staking through legitimate validators currently generates between 3.5% and 5% annually. This is not spectacular, but it is reliable. It is backed by the most battle-tested smart contract network in existence, and the underlying asset has demonstrated long-term value. For people who already hold Ethereum and plan to hold it, long-term staking is essentially free money for doing nothing beyond locking up assets you were going to hold anyway. Liquid staking protocols like Lido and Rocket Pool have made Ethereum staking accessible to people without the 32 ETH minimum required for solo validation. These protocols issue liquid staking tokens that represent your staked ETH, meaning you earn staking rewards while still being able to use your staked assets as collateral in DeFi protocols, effectively doubling the yield potential. Other proof-of-stake networks, including Solana, Cosmos, and Cardano, offer staking yields ranging from 4 to 8%, depending on network conditions. The higher yields typically come with either higher inflation rates, diluting the value of the token, or higher risk profiles on the underlying network. Chapter 3: Real-world asset protocols. One of the most significant developments in crypto passive income over the past 2 years has been the explosive growth of real-world asset protocols, platforms that bring traditional financial instruments onto the blockchain. The concept is straightforward. Tokenize real-world assets, US Treasury bills, corporate bonds, real estate, private credit, and make the yield from those assets accessible through crypto wallets. Instead of earning 4% on a Treasury bill through a traditional brokerage, you earn roughly the same yield through a blockchain protocol with the added benefits of composability with other DeFi protocols. Protocols like Ondo Finance, Maple Finance, and Centrifuge have collectively tokenized billions of dollars of real-world assets. The yields are not dramatically higher than traditional finance, typically 4 to 7% on dollar-denominated assets, but they are backed by real economic activity. They are denominated in stable assets rather than volatile tokens, and they represent a genuine bridge between traditional finance and crypto infrastructure. For conservative investors who want exposure to crypto infrastructure without the volatility of token-denominated yields, real-world asset protocols represent one of the most interesting developments in the space. Chapter 4. Liquidity Provision. Providing liquidity to decentralized exchanges remains one of the higher yield opportunities in crypto passive income, but it comes with risks that are essential to understand before participating. When you provide liquidity to a decentralized exchange like Uniswap or Curve, you deposit two assets into a pool that traders use to execute swaps. In return, you earn a share of the trading fees generated by that pool. On high-volume trading pairs, fees can generate impressive annual yields, sometimes 10 to 30% on stablecoin pairs, and higher on more volatile pairs. The primary risk is impermanent loss, the phenomenon where providing liquidity to a volatile pair can leave you holding less value than if you had simply held both assets separately. On stablecoin pairs like USDC and USDT, impermanent loss is minimal because both assets are designed to maintain the same price. On volatile pairs, the risk increases significantly. Concentrated liquidity protocols like Uniswap v3 allow liquidity providers to concentrate their capital within specific price ranges, dramatically increasing fee generation, but also dramatically increasing the complexity and the impermanent loss risk if prices move outside your range. Most experienced liquidity providers in 2026 focus on stablecoin pairs on established protocols where the fee income is predictable, impermanent loss is negligible, and the smart contract risk is relatively well understood. Yields of 5 to 12% on stablecoin pairs are achievable on the major protocols without taking on significant directional risk. Chapter 5. The Realistic Expectation. Crypto passive income in 2026 is real. It is mature enough to be taken seriously as part of a broader financial strategy. The infrastructure is more reliable, the regulatory environment is clearer, and the mechanisms generating yield are more transparent than they were during the boom years. But it requires education, patience, and realistic expectations. The people winning are not the ones chasing the highest numbers. They are the ones who understood the risks, chose their protocols carefully, and stayed consistent through the volatility. The easiest money in crypto has always been the most dangerous. The boring, consistent yields from legitimate protocols, the ones that do not make exciting headlines, are where the sustainable income actually lives. That has always been true in finance. Crypto is no different.